sinamolo. Aye Jemi adoko Jemi sinamolo. Aye sumanyami.
So the financial system we regulate today is no longer defined only by banks, by balance sheets and banking halls, but it is increasingly shaped by digital platforms, payment networks, technology providers, and now a new forms of financial intermediation. This changing architecture creates enormous opportunities, but it also changes where risks arise and how quickly this risk can spread. For central banks such as ours, the implication is clear. We can no longer safeguard stability just by looking only at individual institutions. In a digital financial system, stability depends not only on the strength of institutions, but also on the strength of the connections that exist between them. So in my remarks today, I'll be brief. I will touch on some few aspects of these. I'll start on the changing financial landscape, and then I will speak on digital finance and the new architecture of financial intermediation. Thereafter, I will outline the evolving role of the Bank of Ghana. Some of the roles I've mentioned in my past speeches, but I'll just highlight them. And then I'll finish up with the responsibility of industry. Industry also has a role to play. Then we conclude nicely. So, colleagues around the world, the rapid advances in technology, changing consumer expectations, new business models, and increasing economic interconnectedness are redefining how financial services are designed, are delivered, are supervised, and are consumed. The boundaries that once separated banks from technology companies, payment service providers, telcos, firms, and other financial intermediaries, these boundaries are becoming increasingly blurred. Digital platforms now facilitate transactions in real time. Then AI. AI is transforming credit assessment and fraud detection. Then you have distributed ledger technologies, which are redefining approaches to payments and settlement. Consumers increasingly expect financial services to be seamless, to be secure, to be personalized, and to be available at the touch of just a button. What matters for regulators is not the novelty of these technologies alone, but the new dependencies they create across the financial system. The challenge before us, therefore, is clear. How do we embrace innovation while preserving the confidence, the stability, and the trust upon which every successful financial system depends? The answer is not to choose between them. It is, on the other hand, to build the infrastructure, the regulation, and the supervisory capacity that allows both to advance together. So now let me touch on digital finance and the new architecture of the financial intermediation. Colleagues, that changing landscape that I have spoken about is building a new architecture of financial intermediation. For emerging and developing economies such as Ghana, that architecture presents a unique opportunity. Technology has the potential to bridge long-standing gaps in financial access, reduce transaction costs, improve operational efficiency, and support the growth of small and medium-sized enterprises, which are the backbone of our economy. Ghana has made significant progress indeed in this regard. Over the past decade, looking back 10 years ago, our country has emerged as one of Africa's leading digital finance ecosystems. In April this year alone, and if I can give you some figures, Ghanaians moved 493.2 billion cedis, 493.2 billion cedis through mobile money across 967 million transactions as at April this year. 26 million accounts were active as at April this year. 26 million accounts. And these were served by 534,000 active agents. The Gibbs Instant Pay settled a further 79 billion cedis. And so you can add that. Point of sale terminals rose from just over 16,000 a year earlier to more than 23,000. And the rapid growth of mobile money, the interoperability of payment systems, and the increasing adoption of digital financial services, these have transformed the way Ghanaians transact and interact with the financial system. However, innovation also brings new challenges, and we have to remember. As financial services become increasingly digital, the nature of risk is also evolving. Cybersecurity threats have become more sophisticated. Digital fraud is growing in complexity, as seen in the recent fraud report that we published. So operational resilience is now just as critical as financial resilience. The increasing reliance on third-party technology providers, cloud infrastructure, and artificial intelligence. These raise important questions about governance, questions about accountability, questions about data protection, and of course, questions about systemic risk. The rise of virtual assets, tokenized financial instruments, and decentralized finance. This is also further reshaping the financial landscape. So while these innovations hold considerable promise, they also pose significant regulatory, prudential, and consumer protection challenges going forward. So what is the role of Bank of Ghana in all these? Colleagues, a changing financial architecture requires a changing central bank. And let me say that again. A changing financial architecture requires a changing central bank. And that underscores all that we've been doing since I came into office, February last year. The Bank of Ghana recognizes that the erosion of the traditional boundaries of financial regulation calls for a corresponding shift in the way central banks approach regulation and supervision. This means broadening our field of vision from individual institutions to the networks that connect them, from traditional financial risks to operational, technological, and cyber risks, and from responding only after innovation reaches the market to engaging with it earlier in its development. That is not an aspiration. It is already underway. Our objective is not to regulate innovation out of existence. Neither is it to permit innovation to outpace the safeguards that are necessary to preserve confidence in the financial system. Rather, our approach is guided. Our approach is guided by a simple but important principle, i.e., innovation should flourish within a regulatory framework that promotes trust, that protects consumers, that preserves market integrity, and above all, safeguards financial stability. The revised Cyber and Information Security Directive, which we launched earlier this year in March, is the clearest expression of that shift. So through this, the bank no longer supervises only capital adequacy ratios and liquidity positions. Under that directive, we are safeguarding the confidentiality, the integrity, and availability of the data that powers our economy. It places cyber risk expertise on your boards. It sets the first comprehensive framework in our financial ecosystem for the governance of artificial intelligence in fraud detection, credit scoring, and customer service. It establishes clear rules for the adoption of cloud technology, and its proportionality framework exists because we listened to the industry even before we issued the directive. We did not do this after we issued it, but we worked with industry in developing that directive. Traditionally, supervision has focused on the soundness of individual institutions. That remains essential, indeed. But in an increasingly interconnected financial system, the stability of each institution also depends, to a large extent, on the networks, on the technology providers, on payment infrastructures, and service relationships that connect it to others. Our regulatory philosophy is therefore evolving from one that focuses primarily on institutional supervision to one that increasingly considers ecosystem resilience. What that means in practice is this: a bank may be financially sound and still be vulnerable to the failure of a shared technology provider, a payment network, or a critical telecommunications service. Supervision, therefore, must consider not only the condition of individual institutions, but also the dependencies that connect them. And this philosophy has shaped our work in three priority areas. The first priority area is modernizing the financial infrastructure. Innovation cannot be sustained unless it rests on rails that are secure, that are interoperable, and that are inclusive. So we are investing continuously in modernizing Ghana's national payment infrastructure, building a financial ecosystem that is secure, that is efficient, that is interoperable, and that is inclusive. A modern payment system is critical national infrastructure that underpins commerce, investment, and economic growth. Next is open banking. Open banking addresses how financial data can be shared securely with customer consent to support competition, innovation, and customer choice. We have taken that project to an advanced stage as of now. We are also continuing our work on the ECD, Ghana's digital currency, but we are exploring its potential application to cross-border transactions and to wholesale payments within the domestic financial system as a complement to the existing RTGS infrastructure that is in place. Then we've been talking about license passporting as well. License passporting addresses how regulated financial institutions can move more efficiently across borders. We are following and supporting regional efforts in this direction, which would advance regional market integration and the broader vision of a connected African financial system. The second priority is modernizing the regulatory framework, our own regulatory framework. Colleagues, infrastructure alone is not enough. As I've said, as new providers and business models emerge, the regulatory framework has to provide both clarity and appropriate safeguards. The objective is not to prescribe every future business model, but to establish clear principles on accountability, consumer protection, market integrity, and risk. And that requires an approach which is proportionate, which is risk-based, and which is forward-looking as well as adaptive. We have prepared the digital banking framework together with comprehensive draft guidelines, and it is now ready for stakeholder consultation. This is to support its timely implementation and provide a clear regulatory foundation for the next phase of digital banking in Ghana. And on virtual assets, Parliament has passed the Virtual Asset Service Providers Act, or the VASP Act 2025, Act 1154. This was passed in December last year, establishing a formal legal framework for the regulation of virtual asset activities in Ghana. We are currently developing, alongside the Securities and Exchange Commission, the licensing requirements and implementation guidelines that will operationalize this act. Now, the third priority is strengthening supervisory resilience. Our oversight must be capable of identifying risks that travel across institutions and infrastructure, rather than remaining within a single balance sheet. We have built our supervision on a risk basis. We have strengthened governance standards and improved data reporting, and those remain essential. But we are now giving closer attention to concentration risk, to shared service providers, and to the operational dependencies that can transmit disruption across the system. The Financial Industry Command Security Operations Center, or FICSOC, is where this is most visible. Designated under the Cybersecurity Act 2020 as the sectoral emergency response team for the entire financial industry, we are extending its coverage beyond the universal banks to savings and loans companies and microfinance institutions. Now we call them a different name. We are extending this to fintechs and, of course, our partner regulators. A financial ecosystem is only as strong as its weakest link, indeed. And a shield that is built around part of the sector is not a shield at all. Now, the responsibility of industry. Colleagues, this responsibility does not rest with regulators alone. It requires early engagement between us regulators. Financial institutions are involved, technology providers, and consumers. And it requires institutions themselves to carry their share of it. For financial institutions, innovation should not simply be viewed as an opportunity to deploy new technologies. It should be accompanied by investments in governance, in cybersecurity, in risk management, in consumer protection, in talent development, and of course, in accountable leadership. When technology advances faster than governance, opportunity can quickly become concentrated risk. Boards and senior management must be able to explain not only what a new technology can do, but who remains accountable when it fails. Now, the need to build human capital for the future. Ladies and gentlemen, every technological transformation is also a human and institutional transformation. While technology is transforming finance at an unprecedented pace, it is ultimately people who will determine the success of our financial system. No digital platform, however sophisticated, can substitute for sound judgment. No algorithm can replace ethical leadership. And no technological innovation can compensate for weak governance. The future of Ghana's financial sector will therefore depend not only on investments in technology, but equally on investments in people. We need leaders. We need leaders who can challenge models, leaders who can understand their limitations and remain accountable for decisions made with technological support. In this regard, the National Banking College has an important role to play, and I'm happy they are stepping into the game. As Ghana's premier institution for banking and financial sector capacity development, the college is well positioned to equip current and future leaders for exactly that environment. And I commend it for that work. Ladies and gentlemen, as we look ahead, the Bank of Ghana will continue to support innovation that expands access, innovation that improves efficiency and strengthens competition, while remaining firmly anchored in our mandate of monetary and financial stability. In conclusion, colleagues, the future of finance is not something that simply unfolds before us. It is something we must consciously design. It must serve the broader objective of improving the welfare and prosperity of the Ghanaian people. The financial architecture of the future must be innovative enough to expand opportunity, but also resilient enough to preserve trust. As institutions become more connected, our responsibility is not only to keep each institution sound, but also to ensure that the connections between them remain secure. Building that architecture is a shared responsibility, and the Bank of Ghana stands ready. We are ready to play our part. So I wish you fruitful deliberations and every success in your discussions today. Thank you for your attention. Thank you.
Please, a round of applause to the governor.
Thank you.
Please give it up for the governor. Fantastic presentation. He says so many insightful things concerning the industry. What the central bank has done, putting in place structures and infrastructure to accelerate the development and a very robust banking system. Please, a round of applause for him once again. Governor, thank you very much. That was a very insightful speech. Once again, I want you to know that the Ghana's financial system does not just exist in vacuum. There are infrastructures that have been put in place. There are systems that are directly linked to this financial system that we are running right now. And for that, we need someone, or we are privileged to have someone who is sitting at the helms of affairs when it comes to digital innovation or infrastructure in Ghana. Help me welcome Mr. Lawrence Aite to introduce our next guest of honor. Please, a round of applause for him.
Thank you, Winston. Good morning, ladies and gentlemen. May I, with your kind permission, stand on the existing protocols and do my simple assignment. Honorable Samuel Nati George, MP, is a distinguished third-term member of Ghana's parliament and the serving minister for communications, digital technology, and innovations. A legislator of considerable standing, he brings to public office a rare convergence of legal expertise, international policy experience, and deep fluency in digital governance, making him one of Africa's most authoritative voices on technology, legislative integrity, and continental digital transformation. Regarding his academic credentials and background, Honorable Samuel Nati George holds an LLM from the University of Laws in the United Kingdom and an LLB from the University of London, a foundation that informs both his legislative instincts and his command of regulatory policy. He further holds an MSc in International Strategy and Diplomacy from the London School of Economics and Political Sciences, an MA in Conflict, Peace and Security from the Kofi Annan International Peacekeeping Training Center, and a BSc in Agric Engines from the Kwame Nkrumah University of Science and Technology. His academic profile is complemented by professional certifications across multiple ICT disciplines. Prior to his parliamentary career, Honorable George served as an assistant director in the Office of the Head of Civil Service Ghana before being appointed as a communications specialist at the Office of the President of the Republic of Ghana. These early roles shaped his understanding of state institutions and executive communications at the highest level of government. His public service extends across key institutional boards. He has served on the governing board of the National Information Technology Agency, that is NITA, and as a commissioner on the National Media Commission, appointments that reflect his long-standing engagement with Ghana's information, media, and technology landscape. At the continental level, Honorable George served as the intermediate past Secretary General of Africa Parliamentary Network on Internet Governance, a role that placed him at the center of Africa's digital policy agenda and reinforced his credentials as a cross-border advocate for open, inclusive, and sovereign internet governance across the continent. His international engagement spans diplomacy, security, and multinational technology policy, reflecting a career built not only within Ghana's national institutions, but across the broader Africa and global stage. Across Parliament, the Cabinet, and the continental stage, Honorable George Nati represents a new generation of African statesmen, combining legal rigor, diplomatic experience, and technology policy leadership to position Ghana and the continent at the forefront of a global, digitally empowered future. Ladies and gentlemen, shall we with a clap welcome the Minister for Communications, Digital Technology, and Innovations.
Thank you. Please be seated. Whew. I was waiting for that to end. Felt like my whole speech. My brother and friend, the Governor of the Bank of Ghana, Dr. Johnson Pandit Esiama, Ms. Gloria Darlene Korte, Principal of the National Banking College, the CEO of Sika Finance, CEO of Mobile Money Limited, Zenith Bank, ABSA, CEOs and captains of industry, regulators, development partners, members of the financial and technology ecosystem, distinguished ladies and gentlemen, all protocols observed, and good morning to you. I thought the governor set the tone for responding to good morning. Good morning to you. Much better. Because if you didn't respond the second time, I would have blocked all your SIM cards. Let me start with a picture rather than statistics. A trader at Katamanto taps her phone to pay a supplier before the goods leave the truck as they deliver them to her. Or a cocoa farmer in the Afram Plains who's receiving a transfer from his son who works in the mines in Obuasi. Either of them have never seen the insides of a banking hall. Not the son in the mine, or not the cocoa farmer in the Afram Plains. Or a young graduate in Tamale who's opened her first savings account using nothing but her Ghana card and a selfie. None of these three Ghanaians I have described is thinking about interoperability protocols. None of them is thinking about open banking standards or regulatory sandboxes. Each of them is asking only one simple question. Will it work? And will my money be safe when it does? That single question, repeated by millions of Ghanaians every single day, is the real subject of this summit, in my opinion. However carefully we phrase it on the conference program. And so I bring you warm greetings with this picture at the back of your mind from the Ministry of Communication, Digital Technology and Innovation. And I thank the National Banking College for convening policymakers, regulators, and innovators around a theme that could not be timelier: innovation for stability, central banking, digital finance, and the new architecture of Ghana's financial future. I want to dwell for a moment on that word, architecture, because I think we reach for it too easily. An architect does not admire the rain and then decide, because of the rain like we've seen this morning, on instinct, to build a roof. An architect actually studies load, stress, soil, weather, and human behavior before even a single brick is laid. What we're attempting to do with Ghana's financial system is more like an architect that's renovating a house while the family still lives in it. We do not get to pause the economy. We do not get to redesign the system on a whiteboard and then switch it back on when we feel we're ready. Every reform we make today in the banking sector, we make under life load. We're stress testing in a life environment. It's a system that Ghanaians are transacting on right now. This morning, whilst we sit in this room, and that is the honest starting point for everything I want to say to you today. So, distinguished ladies and gentlemen, for too long, finance policy and communication policy in this country were designed in separate rooms, in silos, by separate ministries, not communicating with each other and answering to separate logics. That era is over. Mobile money, digital identity verification, electronic KYC processes, and instant payments do not run on financial infrastructure alone. They run on connectivity, on spectrum efficiency, on the invisible architecture of a digitized nation. You cannot digitize a country's financial sector faster than you digitize its information infrastructure and expect the foundation to hold. Some countries try to skip that sequencing, but Ghana has chosen not to do so. We're building both deliberately and in step. We have made real progress. Mobile money interoperability now moves money value across networks that once refused to speak to each other. The Ghana card has become the backbone of a national identity ecosystem. And at the last check, we've done about 90% of all eligible Ghanaians having the Ghana card in their hands. Digital payments have expanded into corners of the economy that cash could never efficiently reach. And our fintech sector, irrespective of its challenges, has grown from a curiosity into a genuine engine of employment and innovation. I do not raise these gains to declare victory. Far from that. I raise them because they prove something more important. When government, regulators, and industry move in the same direction, Ghana moves quickly. The question before us now is whether we can sustain that same discipline as the stakes and the risk grow larger. And before we came into this room, we're having a conversation in the holding room about how AI is accelerating not just the deployment of technology, but the increase in risk to the institutions. Because innovation must move at the same speed of opportunity, but regulation must move at the speed of trust. I want you to sit with that distinction because it's not a call for regulation to slow innovation. No, even though they move at separate speeds, it is a recognition that trust cannot be manufactured at the pace of a product launch. It must be built slowly through consistency, but it can be destroyed instantly through a single breach, a single failed transaction, a single customer who loses money and cannot get a straight answer about why, a single fintech that fails. Technology creates the opportunity. Trust is what allows that opportunity to compound year on year, rather than resetting to zero every time confidence is shaken. That is why innovation is no longer the rival of stability. It has become the condition for stability. And I must credit the central bank for taking strong, decisive action to continue to hold the trust that people have in our financial sector. I thought you would clap for the central bank. At the Ministry of Communication, Digital Technology and Innovation, we measure digital transformation by a single standard. Does it change an ordinary life for the better? That's all that matters to us. Not whether it impresses a conference room or not whether it wins an award abroad, but whether it reaches the trader, the farmer, the graduate that I described in my earlier picture to you. That is why we continue to invest in digital infrastructure, cybersecurity, digital skills, data protection, and an innovation ecosystem where businesses can take risk without exposing citizens to unacceptable risk. The government's task is to build the conditions under which responsible innovation is not the exception that industry has to fight for, but the default within which it operates. We believe three pillars must anchor this next phase. And I want to be specific about each of these three because vague commitments make for comfortable speeches but weak outcomes. So first, interoperability. Telecom rails, banking rails, and fintech rails must speak to each other as though they were built by the same hand, even though they were not. This means harmonized data and payment standards, and it means treating cross-border financial flows as a design requirement, not an afterthought, bolted on when a regional partner asks for it. Secondly, inclusivity by design, not inclusivity by apology. Every reform we table in communications or in finance should be tested against one question before it is approved. Does it reach the unbanked woman in Bongo as readily as it reaches the chief executive who lives in airport residential area? If a policy cannot answer that question honestly, then that policy is not ready, no matter how sophisticated it looks in a boardroom. It must be equitable. It must serve the underserved and the served at the same pace. Thirdly, resilience and cybersecurity. A digital financial system is only as strong as its weakest, least monitored node. Oreko would know that. I say this plainly to industry. Investment in national cybersecurity architecture is not a compliance cost to be minimized. It is the price of admission to operating in this space at all. And it is non-negotiable alongside investment in access and reach. So cybersecurity must not be the afterthought. It must be the foundation and founding principle. Distinguished ladies and gentlemen, let me now speak directly to the innovators, the fintechs, the banks, and the technology partners in this room. Because you deserve more than polite encouragement from a podium. And anybody who knows me knows that I'm hardly polite. You're building the products that will decide whether this new architecture holds. And so I want to challenge you today, respectfully but firmly. Innovate for the customer who has never set foot in this hotel. Not the investor sitting across from, not for the investor who is sitting across from you. The investor must not be your primary target. It is the customer, the ordinary citizen of Ghana. That must be your primary concern. Designed for the woman who cannot read the terms and conditions in the documents and products that you offer. Not only for the ones who can. Build systems that fail safely. Explain themselves when something goes wrong, and treat a customer's money with the same seriousness that you would apply to your balance sheets at an AGM. A financial product that is elegant for its shareholders but opaque for its users is not innovation. It is simply risk that has been repackaged and giving a better interface. And that will not be acceptable under the reset agenda of President John Dramani Mahama. The government's role is not to stand in your way. It is to ensure that when you innovate responsibly, you get rewarded for it. And when you cut corners on consumer protection, data governance, or cybersecurity, the consequences are swift enough, no matter whose ox is God. That is the bargain of a matured financial architecture. The freedom to build that is matched by accountability for what you build. The future of Ghana's financial architecture will not be decided in a single summit or a single policy or a single institution acting alone. It will be decided in the accumulation of thousands of small disciplined choices that are made by regulators who supervise without strangling, by innovators who build without recklessness, by CEOs who are honest to their call, and by a government that coordinates without dictating. Every basis point of efficiency we gain through interoperable systems should translate into something a Ghanaian family can feel. Lower transaction cost, faster remittances from relatives abroad, easier access to credit for a small trader who has never had a loan in her life. And on reducing transaction costs, we must figure a way to make sure that when I pay digitally, it's actually cheaper than when I do physical cash transaction. That's the only way we can continue to drive e-adoption. That is not a technical outcome. It is the entire point, and it is squarely aligned with the reset agenda of His Excellency President John Dramani Mahama. We are firmly convinced that the stability of our financial sector enables innovation to scale, but it is innovation that makes stability meaningful to the ordinary citizen. Stability without innovation is stagnation with a good credit rating, and that's not what the central bank wants. Innovation without stability is speed without a steering wheel. That is chaos. Ghana's financial future needs both hands on the wheel at the same time. Let me commend, in concluding, the National Banking College once again for convening this important summit and for creating a platform for this kind of honest engagement. I'm confident that what is said, and most importantly, what is committed to in this room today, will shape a financial ecosystem that is stronger, more resilient, and genuinely innovation-driven. One built not for the headlines, but for the household. Sorry if I've offended you, but I did it without any apologies. I wish you fruitful deliberations and a successful summit. Thank you very much.
A round of applause for the Minister. Someone will say that is a very Jata speech. Please, a round of applause for him once again. He did not apologize to anyone because he speaks the facts, and when he speaks, the industry responds. There are several conversations across the communication ministry, and when it comes to innovation and policy enforcement, I would like to commend him for doing that. We monitor extensively on the work that is being done, because if you look at the players within the sector, they are very, very loud, they are very, very strong. But in the last few years, we've seen some stability there, and we acknowledge him for the enforcement and controlling the sector. And Honorable Minister, congratulations on that. And we are actually moving to a very important conversation. We received the first half of the monetary aspect from the governor, and also the second half from the communication minister on the digital aspect of our financial architecture. The panel conversations that will be had today and the presentation is where these two are going to synchronize to lead us to building a very formidable conversation and policy structure and initiatives that are critical for the sector's growth. We'll be moving to a very amazing presentation shortly, but before we do that, we'd like to do a brief photo session before, and I would like to call on the governor and the principal of the National Banking College to also join us here on the podium, as well as the Honorable Minister of Communication first. Yes, please, just here briefly. The photographer, the media. Please, a round of applause for him. He has set the pace for our next set of the conversation and discussion, which is the panel session. He raised very critical point, the phases of risks, the consolidation, the sterilization, the inclusion, and also the evolution of the monetary sector, which he highlighted. We've seen conversations when the central bank, how much are the losses reflecting on the central bank's books? What is the central bank going to do about the gold board program? And many, many conversations that we in the media, once the numbers come out, we will question. And I find myself the privilege to analyze those numbers as well. But this time, the conversation, while we're here backed by the National Banking College, is to ensure that in as much as we're speaking, we are building policy collaboration, sharing insight that is critical. And for that reason, I'd like to welcome the moderator for this first panel conversation, Ms. Zita Klinogo, who is going to be our moderator for our first panel conversation. Please, a round of applause for her. And followed by her panelist, Mr. Courage Mate, economist and head of insight at IC Group. Please, a round of applause for him. Also, Professor Patrick Esumin, the Associate Professor of Finance at the University of Ghana Business School. Please give it to him. And joined by Mr. Eugene Okansi, Executive Director of Access Bank, PLC. Indeed, this panel brings together three vantage points that really share a stage. That is market research by Mr. Mate. We have academic and monetary theory by Professor Esumin, and a commercial bank which actually focuses on liquidity operations, on day-to-day operations, Mr. Mate. And I would like you to know that indeed there's been a lot of things that are happening in the central bank. We've seen the monetary policy rate being cut by 1,400 basis points over the last few years, that is from 2025 to now. And indeed, this panel is going to speak on digital monetary transmission, how the monetary policy is transmitting into our digital framework. And so the next person you hear is the voice of Ms. Klinogo, who is going to lead us in this session.
Ladies and gentlemen, I believe this morning a lot of insight has been shared on policy conversations, and we're here to have a conversation on digital monetary transmission. Now, to kick off the conversation, we have Courage Mate here, a seasoned market analyst. We have Patrick Esuming, my lecturer from University of Ghana. So it's good to see you. And Mr. Okansi, a seasoned executive representing the commercial banking space. Let's welcome them once again. Now, to kickstart the conversation, Ghana has made strides. We've moved from a place where now we are seeing a lot of financial inclusion conversation. We've made a lot of strides. On one hand, yes, we are celebrating digital financial inclusion, mobile money, fintechs in those spaces. Now, we would want to start the conversation to ask, would you say that this conversation has opened the space for inclusion of having a conversation on monetary policy? Let me start with Courage.
Right, thank you very much, and good morning to everyone here. Definitely, I belong to the school of thought that digitalization has improved the space and has also created a strong opportunity for monetary policy effectiveness to be realized. And for me, that does not mean that the benefits have been exhausted. I think there's still a strong, vast room for improvement. And you look at the data, and so, for instance, 10 years ago, you look at currency outside banks, and if you look at currency outside bank as a proportion of total liquidity, we had about 16%. Fast forward to today, currency banks as a proportion of total liquidity is about 16.9%. Now, I mean, on the face of it, one could say we've not made much progress. But I would like to look at it from the perspective of the counterfactual, which is, imagine a world where there isn't digitalization, adoption, digital payment platforms, interoperability. Over the last 10 years, we've seen about 10-fold increase in total liquidity in the economy. Now, without adoption, imagine the volume of liquidity that will be outside. And so, from that perspective, digitalization and its adoption of payment has led to improved visibility from policy perspective. So a lot of this manifold increase in total liquidity in the economy is now being captured on digital payment platforms. So policy is not as much blindfolded on that side. We have a lot of liquidity now moving out of policy blindfold to the policy. So it creates better liquidity. To that extent, I believe it has improved the effectiveness and transmission of monetary policy.
Patrick, your comment. Would you say it has strengthened or weakened the effectiveness of monetary policy, digitization?
Good morning
Good
again,
morning.
and thanks to the National Banking College for inviting me. So I will largely side with Courage. I think you have to see that the monetary management and then the transmission and then the effectiveness will probably would have increased, because look, people are going to transact anyway. People are going to use the funds anyway. The way we've gone about, especially the mobile money and infrastructure, and the regulation requires that mobile money accounts are backed one-on-one with bank, some balance sitting in a bank. Means that it allows the central bank to have a strong hold of exactly what is happening, and that you don't have liquidity sipping out of the system. So I think the fact that the regulator appears to, taking a stance that will allow them to have a fair amount of control over where funds are going, even if it's heavily dispersed, because of that single requirement that mobile money funds are backed by some deposit at some commercial bank, then it's very easy for them to keep track. That's why you have a relatively high value real-time data to give us a sense. So in some sense, I think that's been really helpful.
Yeah. See.
Yeah, thanks. So, I mean, I fully agree with the sentiments that have been shared earlier. Just to say that we've done very well as a country to bring people in, because if you look at the data, according to the World Bank, about 81% of the population are in the ecosystem. And I think the next frontier is how you move it from mobile money or banks being able to move money around to how you can create real utility for the user or the consumer. I think that's the next frontier that we really, really need to be focusing on. I also, with regards to digitization, one of the things that has become very apparent, I recall growing up, sitting behind the TV and trying to understand, make sense of all that was being said about macroeconomy, microeconomy. But now, the average person knows that interest rates have gone up.
Yeah.
And that's what it means. Or interest rates have gone down.
Yeah.
And that's what it means for them.
Okay.
So the level of transparency
Yeah.
that we've seen in terms of what is and how it impacts the day-to-day life of the consumer, I think has increased highly. You also talk about information asymmetry, which had been a big problem. But the average person now is really informed. They are negotiating interest rates. And they are asking you to meet them where they are than previously was the case. So I'd say that it has improved speed. It has brought speed because in terms of transmission, things are happening almost instantly. Then in terms of accessibility to data, people, even for instance, if it is mobile first generation, just by looking on their screen, they can tell everything. And then lastly, I think that we've been able to get to the distribution point, but what we do next is where the conversation starts. Thanks.
Fantastic. Now, let's come back to government. We've heard from the governor, we've heard from Dr. Otu. Now, Courage, let me come back to you. Now, government borrowing requirements continue to heavily dictate liquidity conditions and interest rates in Ghana, sometimes sending mixed signals to the market. Now, how do you think fiscal policy and monetary policy can be better coordinated so that it doesn't send conflicting signals to the market?
Absolutely. And personally, I believe that this is one of the, arguably the main challenge of policy choice issues in Ghana for a long time, right? We've had situations where fiscal policy tend to signal consolidation but embarks on expansionary path, and that leaves monetary policy to embark on mop-up exercises, blunting the effectiveness of monetary policy. So the need to coordinate cannot be overemphasized. Having said that, I believe there are a number of ways, practically, theoretically. And I mean, if you look at the fact that now we have policy anchors, right? For instance, last year, the Ministry of Finance passed an amendment to the Public Financial Management Act. We now have a fiscal anchor, a numerical anchor that ensures that the budget deficit on a primary basis or the budget balance on a primary basis must record a minimum surplus equivalent to 1.5% of GDP. Now, we need to ensure compliance with policy anchors. If we have fiscal policy strictly enforcing compliance on this anchor, then the borrowing requirement will be minimized, and we can have a better gauge of liquidity. That said, one of the things I've also realized is that we've dumped the responsibility of inflation management solely at the door of the central bank. But I think we need to elevate the role of fiscal policy in managing inflation. For this is part of the gamut of issues they consider, but it seems for some time, it seemed like it's been in the backbench. We need to bring it forward and allow fiscal policy to play a dominant role in curbing inflationary pressures, particularly those pressures coming from the supply side or cost-push inflation, because these are pressures that monetary policy reach is limited. What monetary policy can do is to try to anticipate the second round effects. But when you target fiscal policy, particularly in the areas that amend supply shocks or mitigate supply shocks and cost shocks, then you create the condition for monetary policy to reinforce it and trigger sustainable disinflation. last year, for instance, if you look at the 2025 budget, one of the things we picked out was the budget earmarking about 1.5 billion cedis towards, supporting the production of price-sensitive agrarian produce. And we saw the impact on food inflation. What that did was that it created the room for monetary policy to quickly embark on normalization of policy rates, hence the cut in the policy rate over the period. Because we need to also realize that if policy rate is elevated for too long, it can also become a threat to financial system stability. So for me, those are the two key things. Ensure compliance with policy anchors, elevate the role of fiscal policy in managing inflation. Yeah.
So that leads me to my next question. So would you agree that we need a framework, something more formalized around getting, around the fiscal monetary policy transmission? Do we need a framework in place to coordinate that, a more formalized approach?
I would think yes, we do, but in a structured form, not one that compromises institutional independence. And the objective for me should be not one that necessarily requires joint decision making. I would imagine a structure that requires information sharing, timely information sharing, and more importantly, policy sequencing. And when I talk about policy sequencing, I can look back at 2025 and we noticed something very important in the market. And for instance, in July, right, I think the second half of July, we saw significant sizes of volumes of T-bill maturities coming up. Yes. And we were wondering how they will be refinanced. And interestingly, either by mere coincidence or strategic coincidence, the central bank altered the auction system for BOG bills. Yes. And we saw a sharp drop in the yield on DOG securities from 28% to about 10%. Yeah. It was even leading up to the MPC meeting. And so the market thought that there would be a sharp cut in the policy rate, and that yield on OMO bills also became less attractive. We saw a flow of liquidity immediately from OMO securities into Treasury securities, allowing the Treasury to raise sufficiently to refinance those huge upcoming maturities. That is the extent of coordination. Immediately, the yields reverted back to align with the policy rate. This liquidity management, coordination between fiscal policy and monetary policy is very essential. And so if you can formalize it in a structured manner to support policy sequencing, it will help a lot to sustain the stability.
Any comments, Mr. Isumi?
So, more broadly, I'm supportive. Yeah. Just always a little cautious. Yes. I think that, when times are good, or if you look at where we are now, because we have a fiscal authority that seems very determined to maintain, a particular regime, a particular discipline. You have to be careful that you don't leverage on that and expand the scope, because it's not always the case. It's not always going to be the case that the fiscal authority will have that kind of intention. Yeah. So while the coordination is good, I think I'll hasten a little slowly before we go and formalize any arrangement. You never know. You never know. Yeah. And you have to understand the time of the political cycle where we are. Yes. And anticipate that, the mood swings. Yes. And I believe that's where the conversation is coming from, pushing for the change. Yes. And then, so at the moment, it looks like the finance ministry and the BOJ are singing from the same hymn book. But it's always not going to be the case. So you have to be careful. That's true. Exactly how we formalize the new framework.
That's true. Mr. Okansi.
I'll just say that the market is just watching, right? Because of what we've been accustomed to in the past, there's always that suspicion that won't be able to hold the line. Yeah. So there's always the average person on the street, or the market is watching what you say and what you're doing. Yeah. If you're consistent, then you even give confidence. So
Yes.
I guess that's what we have to. But so far, the level of discipline we've seen, I don't have any doubts that but we just need to make sure that what we say by way of policy and the day-to-day decisions that we're making, they sync.
Okay, so whilst you have the mic, what lessons do you think we must learn coming out of a debt restructuring going forward as a country?
I think that what happened to us, and I feel Ghanaians are very resilient people, because if you look at what happened and how we've managed to recover, I mean, it just, and you know, there's also some prior history as well. And for me, that's the thing that we need to be mindful of. For how long would we be able to build people's confidences to a certain level, get them to be fully participate? We're talking about financial inclusion, right? Get them to fully participate in the economy. And then when these things happen, sometimes they take the hit alone. So how do you sustain that level of confidence? And that's what I'm saying the market is watching. There are even still some people who are unsure.
Yes.
Right? Unsure whether if they take a step, it will be because of what they've seen before. So, I mean, I think that that's where we need to really, really focus on. I see that the confidence is coming back, and that's why we cannot fail. Basically, we cannot fail because you can't take people through that kind of, that one moment you begin to build confidence, and then you go there, you take them through. Then what you are literally doing is telling people that keep your money out of the formal system, which we're doing a lot to bring in. I mean, based on what Carrie shared earlier, a lot of progress have been made into mopping liquidity into the system. But these things don't bode well for us. So for me, it's mainly how we still keep the discipline and get the confidence that we've managed to gradually win back to be sustained.
Courage.
Yeah, sure. So there have been a number of lessons in my view. And one of the discussions that came up post-DDEP was whether risk-free assets are actually entirely risk-free. And it's become a question of, should we start imposing strict asset allocation limit across the sector or across the industry? That said, what became clear to us is sovereign risk can quickly transition into financial system stability concerns. And before the DDEP, banks held about a third of treasury securities on their books. And post-DDEP, we saw all the stress that came on banks, particularly from profitability ratios, and the central bank had to step in to offer some regulatory reliefs. And one of the windows just closed last year. And it just opened the mind of our treasury managers and everyone at ALCO that we now need to get serious with how we allocate liquidity. And definitely going forward, this is a lesson for us. I think also one other important lesson is the importance of building debt service buffers. Because I remember in 2015, we actually set up the sinking fund. This was supposed to help us manage our debts. Have we done well on that? Well, the debt exchange program answers that if we did well on that. And so going forward, I guess this is something we need to take serious as we embark on the journey of keeping the debt sustainability metrics in check. Finally, one of the things that I've also realized is that you cannot monetize your way out of fiscal distress, right? Because where you don't consolidate, where you become lax on fiscal prudence and fall back on the central bank, it will catch up with you. And ultimately it did. And so it goes back to my earlier point. We need to stay true to the policy anchors. We need to stay true to the acts that is guiding fiscal policy and monetary policy operations. And so that we would say to ourselves, most likely never again at this point of debt restructuring.
Let me just come back to Doc. Would you say our traditional monetary policy is becoming less effective in this very digital era?
Not necessarily.
Okay.
I think So when you're talking about the digitized era, it's a whole spectrum of things, of what a combination of tools and instruments are you allowing, and at each stage, what kind of adjustment do you need to do to how you do traditional monetary policy? Traditional monetary policy, essentially, the financial intermediaries play a big role. The central bank don't deal with non-financial institutions in that sense. Everything is transmitted to them. But if you look at the proliferation of different digital financial tools, there's more direct, the central bank can transmit without having to go through the intermediation. So I think it depends on where you are and what you allow. Now, when the head of research was towards the end he was talking about the whole variety of tools and instruments and what central banks are allowing in some places and what they are not allowing in other places. Currently in Ghana, so we've embraced the fintechs, we've managed to bring them under regulation. And it appears that we've been careful to ensure that things we put in policy framework before we open the space. So I think he spoke about 3 specific legislations. Yeah. It appears that the virtual access regulation needed to put in place before they allow the Ghana, the
ECD to take flight.
But even with the ECD, it depends on what you allow and what you don't allow.
Yes.
Whether you are going to allow it to be an interest-bearing asset or not.
Or not, yeah.
Or whether you are going to allow full convertibility between the CD and the commercial bank assets, and who you are going to allow to participate and who are not going to allow to participate.
Sure.
So the tools are still going to be relevant, but the implementation and what you are looking at have to be adjusted. So I wouldn't say that the traditional tools become less effective.
Yeah.
If you are successful in ensuring that you are bringing all the innovations under one regulatory regime, as we seem to be doing, then it gives you more scope to adjust your policy instrument to ensure that they become more effective.
Let me come to you, John, lastly. Would you say competition from fintechs is also affecting monetary policy transmission? In the space, are we facing competition from the fintechs in this banking space? And it's also affecting the transmission of monetary policy.
Yeah, I like the bit of are we? Are we? Because
we are in this together.
Absolutely. So it's been like the traditional banks versus the fintech. But really, I think what has worked for us is the fact that it's been more of collaboration and partnership.
Okay.
And we're seeing this monetary policy, the impact of monetary policy come through because the fintechs by themselves, for most of them, cannot underwrite some of these risks, right?
Sure.
And we bring in the discipline we've built over the years by way of corporate governance, risk management, to enable, because the monetary policy by itself, if it's not backed by these things, then you would end up having defaults. So for instance, rates have been dropping consistently. So it looks like it's a good time to borrow, right? But once you start lending aggressively, you also stand the risk of
NPLs.
High NPLs, especially in an environment where people think that bank money is not meant to be paid or money from a financial institution is not. It reminds me of recently I had to pay a vendor for a service, and I didn't know I had 2 of his numbers. So I just sent it to his number. Then he calls me complaining that I've killed him. Why? Because he owes a fintech, right? But that money was given to me. I gave the fintech that money. So I told her, look, if I knew, it's unfortunate, look, it's good enough that it's ended up there, but if I knew, I would still have put it there. But he was complaining because the view is that either it's not meant to be paid or you can delay payment, etc., etc. So for me, the policy signal is good.
Yeah.
And that's why we have to complement them. We have to support, help them underwrite the risk, just so that we have a more healthy banking system or financial sector. So good signal, but I don't believe one can do without the other. And yeah, so that's my take.
Fantastic. Thank you so much. Unfortunately, we are pressed for time, so we couldn't delve deeper into the conversation, but I'd like to say thank you all for your time this morning. Let's give them a round of applause.
Please,
fantastic.
We would like to know if there's any question anyone would like to ask our panelists. We have 3 minutes to do that. If you have any question, you can also raise up your hand. We'll come to you. Or you have any submission to what you've actually shared here?
Any question? I'm sure we have people from the banks. Any contribution? Anyone from the fintechs? Yes, the lady there.
I'll bring you a microphone. Please stay with you.
Okay.
This has been a very interesting question. And looking at the responses from the various industry players, from academia to commercial to, I think that I can still see some gap which needs to be bridged from an academic perspective to what pertains in the industry. So my question is to all of them. What can we do to ensure that once people are coming from academia, there's real life situation which they know from that side, blending into what pertains in the industry? What can we do? Because we have different stakeholders in this summit, and we need to ensure that that gap is bridged, so that whatever students we are also churning out coming into the industry have that real life impact. Thank you.
Okay.
Courage.
Oh, yeah, for me, my biggest, I don't want to say regrets, okay, but something I wish I did more of was internship when I was in school. Because, look, I spent virtually my whole life on campus at the BAM Library, reading about all the theories underpinning my discipline.
Typical bookworm.
But in the end, I needed the field to execute. And when I got into industry, I realized that there is that gap. And I couldn't hit the ground running. Now, imagine a situation where in between semesters, I had the opportunity to intern in a sector or companies where they actually practice what I intend or my career path is intended to follow. That gap would narrow by the time I'm ripe to enter industry. I may even identify problems for further research in school and be ready to solve them once I enter the market. So I would actually plead for our educational system to make it probably more mandatory for students to do a lot of internships, industry experience, gather industry experience, and be able to identify problems for research and solutions.
Prof, very quickly, I mean, on the back of all that has been said and from her contribution, you would agree with me that, I mean, there's this saying that a lot of the things we learned in finance school is not the case as we see, as we've seen over the last few years. What do you think we can do from the academic perspective to better our knowledge? And what are our takeaways?
Good question. I think that, I don't think it applies to only people who are working in the field of finance. I think more generally.
Yes.
I think so. There has to be many different avenues for collaboration.
Yeah.
So he's already mentioned the internship, but beyond that, I think what we try to encourage where I work is bring more practitioners to serve as guests, to update, so it gives the student opportunity to hear from the theories we teach them, how things are actually working.
Yeah.
So I think by and large, it's been done, but I think there are still some kinks here and there. Then we also do have a lot of industry people who actually teach on our programs. Okay. I think at the Department of Finance, the last time I checked, we have about 30 non-pure faculty people from insurance, from different places who teach on our program.
As a way of introducing the practical aspects.
So that they also come with a completely different perspective. Yeah. And then we do have cases where an academic co-teaches with a practitioner. Yeah. So we are trying. Hopefully the results will start showing soon.
Sure. Thank you so much. And thank you so much to our panelists once again. Thank you.
All right, so can we take a group picture? Zita and the panelists. Photographer, we're waiting for you. Great. Please a round of applause for them. Ms. Zita Klogo, fantastic moderator, charismatic economist and head of insights at IC Group, and Professor Patrick Esuming, the associate professor of finance at University of Ghana Business School, and Mr. Eugene Okansi, executive director of Access Bank PLC. This is really insightful. Please a round of applause for them once again. Ladies and gentlemen, anyways, I still want you to know that you're still at the Financial Architecture Summit 2026. This is indeed organized by the National Banking College in collaboration with Sika Financial Group, and we are still here. Kind courtesy to our sponsors, the Bank of Ghana, Mobile Money Fintech Limited, Zenith Bank Ghana, and Sika Financial Group. Our media partners for this amazing summit is the Joy FM, Joy Prime, Joy Business, and Joy Prime and Joy News as well. So yes, we're still live on these channels and bringing you up-to-date information. And at the end of the day, you will indeed be seeing a lot of articles and news stories and various bulletins, making sure that the leverage and the mileage of key conversations do not just get limited here, but reach the key market players for policy formulation, for insight, and indeed for information purposes. Once again, I want you to know that in the beginning, when the central bank governor was speaking, the communication minister was speaking, the presentation that was made by the head of research, one key phrase that keeps coming up is stability of the cedi and also building reserves. The confidence of the economy that we've seen so far, per your assessment, you hear from the Gold Board CEO, is we are in a good place to build reserves, to the extent that the government has put in place a reserve strategy program in the next 5 years to build it by 2035. And this re-echoes the essence of this next presentation, which is going to be on the topic FX settlement infrastructure, capital flows, and treasury strategy in a volatile global environment. And to lead this presentation, help me welcome the CEO of the Sika Financial Group, Mr. Emmanuel Shirifi. Please, a round of applause for him.
Good afternoon to everyone, and thank you for putting together this very interesting event. I want to appreciate the National Banking College, the Central Bank of Ghana, the governor, the minister for gracing this event, and we're happy to be here as Sika Financial Group. So without much ado, I'm very much honored to lead this conversation, basically around FX settlement infrastructure, capital flows, and treasury strategies in the volatile global environment. And I believe in the previous submissions and conversations we've had so far, a lot of these conversations are surrounding how market is changing, the underlying architecture of the new age of technologies that would go ahead of markets to change how trades are done, settlements are done within this market, and address the core issues within this market. Now, before I jump into the presentation, I would like to state that there are 4 pillars I'll be speaking on for this topic, and these 4 pillars are around risk, and risk primarily around principal risk or head start risk, default waterfall when there's default in the market, and then also the second body of subjects I'll be sharing will be around liquidity, which is around where the liquidity in such markets are concentrated, and then also around volatility, and then finally fragmentation. So first of all, I'd like to introduce Sika Financial Group. So I'm sure most of you haven't heard of Sika Financial Group, but by way of introduction, we are building what will be the first financial market infrastructure for FX settlement, primarily for the Global South. And just to step back, in the global financial market, today the BIS reports, I think in 2025, on the triennial report that there's about $9.6 trillion that exchange hands every single day. As incomprehensible as that number is, that's the reality of the financial market. And FX is the largest financial market globally, given the volumes that move through the systems on the daily basis. But then out of that $9.6 trillion that exchange hands every single day, it's also reported that about $2.2 trillion daily is exposed to principal risk, which is basically counterparty defaults likely happening when these monies are exchanging hands. And we're glad to say that, when you look at matured markets, especially across the G10 currencies, there are systems in place that address issues around principal risk, and then also liquidity, and then other, market mechanisms that, or other market stuff that impact the market. And it's systemically, systemically, most of the African markets in the global south, currencies have been excluded from this, global systems that ensure, the risk mitigation, and then ensure that most of this market, are liquid enough. And this is where we come in. So we're building that infrastructure. And since we, launched, there's been 0 settlement failures. 14 corridors are live. We ensure payment versus payment to mitigate, risk or principal risk. And then we've launched what we call the multi-tiered liquidity nexus, which is basically to deepen markets. So moving on, I would like to start off by, how the FX market is structured. So when you go to any market, first of all, there are various actors in the market, right? You have your central banks, you have your custodians and liquidity providers, you have your corporates and treasurers, and then you have your commercial banks, and now, the fintechs, and then you have your correspondent banks. Now, most of these market actors are supposed to be connected or integrated in a way through a CCP or an FMI that provides central counterparty services, which ensures that the market is, de-risked, a lot of the liquidity is not fragmented, and then ensuring deeper participation across this market. And you realize that across, the global south, corridors have no neutral nodes at the center. Banks settle bilaterally and gross with each other, which basically, worsens the liquidity issues across this market. So, one market, 2 realities. We have 2 global hemispheres. You have the global north, and then you have the global south. And most often when we hear anything around the global south, it's usually riddled with risk or perceived market risk. And then it's also riddled with, liquidity issues, especially when it comes to, foreign exchange and then settlement. Now, in painting, a picture of what the global north represents, especially the G10 currencies, you're looking at about $9.6 trillion in daily global FX turnover from the, BIS triennial report in 2025. But then only 18 currencies participate on the system that process this, settlement, which is, CLS. So CLS is the name of the company that process the FX settlement for these 18 currencies. And they process about $7 trillion every single day. but then it's exclusively to, developed market currencies. And they use delivery mechanisms like multilateral netting to deepen market liquidity, and then also payment versus payment to eliminate principal risks within the market. And then also, you realize that across the global north, there's deep liquidity, tighter spread, settlement risk is close to zero. So most of the risks that we're, kind of like exposed to across the global south, it's non-existent, near non-existent there, because there are systems and infrastructures that are in place to ensure that. But then when you come to the global south, what you're going to find is that most of the EM and frontier markets, currencies, are entirely, outside CLS coverage. So a lot of our currencies are not participating on such global systems to help us de-risk and then also improve liquidity. And then also correspondent banking and pre-funding, remain the default settlement model. And then also finally, wider spreads, and then also hairstart risk is basically, heightened within this market. So what is a CCP, or what is a central counterparty, and an FMI? What do companies like this do? What do companies like SICA do? And why are such infrastructures and companies very important in the ecosystem? Now, when you take a look at what a central counterparty is, it's basically an infrastructure that steps in between a trade to ensure that both sides of the market basically fulfill the obligation before a trade happens. Let me paint this analogy. So think about a global multinational corporation like SpaceX now offering, a service, the internet service Starlink. So they launch rockets into the skies in America. They have dollar cost in doing this, but then they're providing these services across markets that lack that internet infrastructure, aka, markets like Malawi, Ghana, Nigeria, etc. Now, with such a company spending, millions and billions to do this, imagine they sell the services in markets like Ghana. What is going to happen is the service is going to be paid in the local currency that the service is being offered in, because most of the payment methods and most of the currencies that the users are issued with are pegged to the local currencies in those markets. So imagine paying SpaceX for your Starlink in Ghana cedis, but then SpaceX has obligations to provide this service with a dollar cost. So the process of moving their funds, to the US in order to ensure that this service is continued, usually they'll go to, the central banks or commercial banks to see how they can get this exchange done. But then sometimes the market doesn't have enough liquidity. Imagine you're collecting $1 million equivalents every day. The market sometimes don't have the liquidity to, facilitate these transactions or FX movement. And so sometimes they are left to fall back on the secondary market or, other counterparties in the market. But then these become bilateral, and often you have to look at the trust. So imagine, a big company like that having to deal with, an average company who says, hey, give me your local currency and then I'll, give you the dollars in the US in hopes of doing that. Usually the trust to start that doesn't exist. So this is where central counterparties come in to ensure that there's trust between those two counterparties before exchange happens. And then also for financial markets, it's basically, a systemic plumbing happening across payments, clearing, and then also moving of money safely across markets. So, the diagram below is basically to show you what it means for, bilateral settlements happening, which is basically you have to find a guy who needs $1 million equivalent to the CD, and then also the opposite direction of that flow before that exchange happens. And other flow is basically showing how multilateral netting deepens or reduces gross settlements, which basically means that you settle the net positions, which reduce liquidity demand by 60 to 90% in such instances. And today, for financial market infrastructures like CLS, there's over 95% liquidity reduction for most of the settlements that happen, which means you don't need any external liquidity to happen post the multilateral netting. Now, what the Global South Treasury teams actually face. So when you come to markets like Ghana and the greater Global South, there are several challenges that Treasury teams face. One will be reliable reference rates. The second one will be interbank versus parallel market rate blindness. So I'm sure we're all familiar that with the fact that in markets like this, there's the interbank rates and then there are also parallel market rates. But then the liquidity concentration often sits, in the informal market. So that's also another conversation. But then there's also issues like liquidity that disappears. Liquidity is seasonal across this market. And then also the FX depth without a hedge. So, forex are mostly almost non-existent in this market. So your hedging strategy has to, be really on point in order to de-risk from this market. And then also the counterparty trust gap. So, without any central counterparty ensuring trust between all the counterparties executing settlements within the market, it further deepens the gap and trust within the market. And then also zero cross-market volatility. So, the market is very volatile due to the seasonality of liquidity, etc. Now, moving on, why this has outlived every reform cycle. Basically, 4 key reasons. CLS was built for G10 liquidity. So, you wouldn't necessarily have a fit for emerging markets and frontier markets being direct fit participants on, CLS. And then also correspondent economies don't hold, which basically, issues around compliance cost being escalated. And then also there hasn't been any private CCP built across this market for the Global South, which is why, at Sika Financial Group, we took the mandate to ensure that we're bringing the same matured market execution and trust across, the Global South. And then interbank FX remains fragmented, which is something I believe we all, relate to. I'm going to talk about where we believe the market is heading. So first of all, local currency settlement, which is basically a key, conversation across multiple sectors these days. Now, we also believe that, regional payment rails at scale is where the market is essentially heading. And then also cross-border pilots. There's been a lot of cross-border conversations and pilots happening to ensure that there's easy and, more means to be able to facilitate cross-border transactions. And then also smarter triangulation. So instead of, being focused on one liquidity avenue, how do you look at smart triangulations before, getting your FX to another currency? And then primarily, we believe that the direction of the market is heading towards having a private CCP or central counterparty infrastructure to ensure the trust gap and liquidity, issues within those markets being resolved. Okay, so there are 3 pillars, but really it's one architecture. And for this being the Financial Market Architecture Summit, I want us to look at the 3 core pillars of the financial market, which really is one architecture in its sense. So one is the settlement infrastructure, the other one is capital flows, and then the other one is the treasury strategies. But then when you look at all these 3 pillars, they have to coexist as a single infrastructure in order to ensure, settlement, capital flows, and treasury strategies within this market are resolved. This is just a visualization of what that architecture could look like. So multi-layered liquidity nexus, basically bringing market depth. And then also, with that liquidity structure, basically bringing the core bank, banks as tier 1 liquidity, and then also PSPs and non-banking liquidity into this nexus, and then also corporate treasury flows into this nexus to deepen and increase liquidity flows within this market. And then where we believe this is going to start, we believe, regulatory recognition, interoperability standards. The Honorable Minister talked about this quite a bit. liquidity and default fund backstops to reduce the systemic risks that is likely to happen within this market, and then public-private collaboration, which is basically what is birthing this inaugural financial architecture summit. So those are, those are things in place that we believe would further ensure that, the market is moving towards the right direction. And then I would like to, close my presentation by leaving you with one statement. Every financial crisis this century has started with a settlement failure somewhere in the chain. The next chapter of global financial stability will not be written by avoiding volatility. It will be written by the institutions willing to build the plumbing that survives it. So, yeah, thank you very much, distinguished ladies and gentlemen. I really, I'm glad that we got to share a lot more about this subject with you. Thank you.
Thank you very much, Mr. Emmanuel. That was a very insightful presentation. Please, a round of applause for him. This is free FS Marketing Side Lecture. So the things I've learned this morning is deep, and I want to appreciate this fantastic presentation by the CEO of Sika Financial Group, Mr. Emmanuel Ishirife. And he spoke about the FX settlement infrastructure, the capital flows, and the treasury strategy in a volatile global environment. And very shortly, we'll be watching the key convener of this event. That is, we went for a commercial break when we were watching the video of the Ghana Banking College. So we are returning back to that particular program, which is going to go live shortly. So let's have it.
National Banking College was established in 1994, exactly 30 years ago. The institution has actually done well, training a lot of bankers, those in the financial sector, with resilience and perseverance. We've been able to come a long way.
Around 92, 94, there weren't too many banks as you have today. So around that time, Bank of Ghana took a conscious decision to license a lot more banks. And the need for a banking college was felt at the time. A training college for practitioners, banking practitioners.
The Bank of Ghana liaised with the Reserve Bank of India to understudy the structure of their National Institute of Bank Management. So the Bank of Ghana seconded staff to the National Banking College to begin to run the college.
We acquired a plot for the permanent institution because the idea was to make the banking college a premier banking college for West Africa, if not for the whole of Africa. In fact, if we heard of anybody who was very good at any particular topic, we made sure that we invited the person to come over to lecture, because all the participants were from their own institutions as well as other banks.
So what we do here is that we have a research department that goes out there to ask of what the industry people actually need.
In 2021, the Governing Council of the National Banking College approved a 5-year strategic plan to help drive its objectives, leveraging technology for excellent customer service and contributing to the growth of the financial services sector through training. At inception, the National Banking College clearly focused on Ghana and the needs of the industry at the time. Over the years, we have seen the college move from just Ghana into the sub-region. So currently we have a collaboration with posterity thinkers in Sierra Leone, where programs from the National Banking College is run on a regular basis in Sierra Leone.
A round of applause to Ghana National Banking College, and also to the principal, Ms. Gloria Darling-Corte, for phenomenal work being done at the institution, and also to the board. Please, you can do better. Wonderful. Now we move straight to our next panel conversation, which is going to be on the topic which was set previously by Mr. Emmanuel. He laid a foundation. Now, this topic is going to be the FX volatility and solutions. The moderator for this session is Ms. Na Ajelebano. Please, a round of applause for her. And she'll be joined by her panelists, Mr. Mark Millington Buck, the MD of Bearman Pro. Please, you can also join us. Followed by Mr. Viral Naik, the CTO of Sika Financial Group, as well as, and Mr. Jojo K. Bannerman, head of global market at SCB. This panel spans from corporate treasury advisory, financial technology, and the trading desk of one of Ghana's largest international banks, Standard Chartered Bank's global market desk, a genuine end-to-end view of how FX risks actually moves through the system, and corporate CFO's hedging decision to interbank rate itself. So, Mrs. Bano, I leave you to the hands of your panelists.
All right. Thank you, Winston, and thank you, audience, for this opportunity. We are going to talk about foreign exchange, and I believe every business here has something to do with foreign exchange. Mr. Ashrifi did a fantastic presentation on the settlement structure that they are hardly working on and which we need for our industry. We have very learned minds here which will share perspectives on what is happening in that front to help our settlement systems, to help our businesses, and to help the economy in the end. So we'll dive straight into that. So Mark, Viral, and Jojo, thank you again for being present with us here. Okay, so the first question will go to everybody. In fact, I would like to hear your views on this first one. And it is that Ghana's macroeconomic indicators have improved considerably over the past years. I mean, we can all testify that the indicators are improving. GDP is getting better. Inflation has reduced. We are now at 5.3. Interest rates are coming down. And of course, GRR has also reduced drastically. But people like me, and I'm sure your good selves will say that the inflation, it is what you feel in your pocket, not what the Ghana Statistical Authority announces. So please, let's hear from you. What do you think, my panelists, what do you think it would take for improved monetary conditions to translate into real confidence, investment, and economic growth for all of us? How can we feel the money in our pockets, aside the figures? And I think we can start with Jojo.
Okay. All right. Thank you. And thanks to the National Banking College for the invitation to join and speak to you all. I think they've added a bit of bass to my mic, so my voice is a little bit more deeper than usual. Look, I think the confidence in the economy is, or the seeming lack of confidence in believing the economic story is because we've seen this cycle over and over again. And the key question that everyone is asking is, how is it going to be sustained and how do they manage things significantly different from the past? Having 2 years of macro stability followed by 2 years of a little bit more physical spending, and then you end up having a fiscal crisis down the line, another 4 to 8 years. It's been the cycle we've always seen. So clearly, this time around, one, the market is going to need a little bit more time to digest what is happening, to see that the policies, the fiscal consolidation on the Ministry of Finance side, the monetary policy coordination with the fiscal is sustained over a longer period of time, and that would translate to confidence from the general public and also translate to the business investments that people need to make. So yes, we are in a very good place, much better than we were 3-4 years ago, but sustainability of the policy really is what the market needs at this point in time.
Thank you, Jojo. I like that. Sustainability. Sustainability. Thank you. Viral, please, let's hear from you.
Hi, thank you. I'm not an economist, but I think what happens is that when you are in a stable period, there's a risk premium generally attached to a number of things, and that takes a while to go down. So with the stability and continuing stability, the direction continues, it will come down. It's a matter of time. That will take immensely. The other thing is normally inflation raises the cost, inflation goes down, costs still stay there. And as you said, everybody feels the pinch. The wages normally increase in wages. So, it takes time to increase the wages and create disposable income that then flows into the economy. So that takes time as well. So I think the direction is right, and it's important to continue the direction and show the stability to, and you'll see the difference.
Thank you. So what Viral is saying is that we should all be patient. We should all be patient. Gradually, things will trickle down in our pockets. Thank you, Viral. Mark.
First of all, I'd like to thank the NBC for the opportunity to be here today. You're probably wondering what I'm doing here. Obviously, I stand out. So I work for Beerbaum. I'm one of the ambassadors and global advisors. A little bit about Beerbaum. They provide central banks, commercial banks, corporates, and financial institutions with a treasury trading platform and access to global liquidity ecosystems. But why am I here? Well, I came to the ACI conference a month ago. It was announced by the NBC and the principal, Madam Quelly, that they were offering a treasury simulator to the national, that Beerbaum was going to offer a treasury simulator to the National Banking College, a platform for simulated treasury trading for FX. And we were persuaded by our ambassadors from the ACI, ACI Switzerland, ACI Europe, to help provide the infrastructure to assist with the ACI Treasury Dealing Certificate. This project has been driven by NAR and the college, but also by the local bank community. They've actually engaged in this project and helped build this simulator. It's a proper, realistic simulator for treasury training. I would like to say that if you train with a reputable banking college, with a realistic simulator, it's a really important development in the country's financial infrastructure. An AI-driven market simulation allows traders and treasury professionals to practice under realistic market conditions, with live market pricing, but trading against a robot, before they enter the market and manage live exposure. This really improves the capability without increasing financial exposure. As someone said, I think it was Madam Quelly herself on the last panel, you don't get to fly an airplane without first going through simulation. You don't get to drive a Formula One racing car without sitting in a simulator. Ghana has this, the college has it, they operate it with the community, take advantage of it. So, other than that work, why else am I sitting here? So, why did I end up at Beerbaum? The reason for that is simple. I was part of an emerging market economies national and central bank working group on international financial cooperation. So at the request of major US and European banks, I led an internationalization of major exchanges, what you like to call emerging market economies. I worked with them on how to incorporate international standards in their marketplaces. I led global investor relations to attract international investors to come to them. And I helped provide and promote international access to the emerging market economies, exchanges, and clearinghouses. So today, I'd like to answer these questions on that basis with that experience to give you an understanding. So, Ghana's macroeconomic indicators, yes, they've definitely improved. So from when I went out after the ACI Global Conference and started speaking to investors about Ghana, this is the feedback they gave me. Really, really has improved over the last few years, particularly over the last year. Businesses and households obviously remain cautious. The money in the back pocket, that's what you talked about. This is where there's still caution. So what will it take for improved monetary conditions to translate into confidence? Investment and economic growth comes from that. Well, I think there's some simple solutions to that. Obviously, the improvement in Ghana's macroeconomic indicators is undoubtedly encouraging. Low inflation, greater exchange rate stability, the FX market we're talking about, but they're not sufficient conditions for confidence. Confidence grows not over a single year, but over 5 to 10 years, if not more. So this patience, that's the key. Patience backed by a fantastic central bank that understands that, fantastic Ministry of Finance that supports it. And I think it's important that businesses make investment decisions, therefore, over the 10 years, 5 to 10 years, not 5 to 10 months. That's how they get the confidence in today's policies that'll be credible tomorrow. So, first, policy, consistency, predictability. Second, efficient access to foreign exchange. Even if the exchange rate is stable, companies need confidence that they can access liquidity. We're lucky to have groups like SICA here today that want to help promote that ease of access. Beerbound promotes that ease of access. That's why we're here today to help. Third, risk management. Many businesses still spend too much time, from what I understand from an international perspective, to predict where exchange rates are going rather than managing their actual exposure right now and today. Modern treasury management is about protecting margins, not forecasting currencies. Protect your cash flows. Use the technology available to you that can create the confidence, better market transparency, better electronic trading, real-time analytics, and all these things will improve your ability to make the decisions on your cash flows as they come to you today.
Okay, Mark. Yeah. Thank you, Mark. Thank you. That was extensive, I must say. But the key thing I pick is what the other two gentlemen have retreated. Stability, sustainability, patience. Patience. So please, today, we are being asked to be patient. Let's be patient with the government. Let's be patient with our leaders. And hopefully, the economy will improve and then we'll feel the money in our pockets. All right, we'll continue. And then I'm coming back to you, Jojo. So regarding this patience, of course, the financial sector is key in every economy. And there are business representatives here. We have the CEO of AGI here, and there are other companies present. But when it comes to FX, we know that many businesses like to speculate. Okay, there's a lot of speculation on the markets. The current government, the central bank, they are trying to curb activities on that front, but it's something that is still with us. And only a few banks, like your bank, deal in hedging products. So please, Jojo, today let's attendees here. Should Ghana be actively developing a deeper domestic derivatives market? And what safeguards will be required?
Okay, thanks for that question. Let me take it from another perspective. Rather than just developing the derivatives market, let's take a step back. The step back we're taking to is risk management culture. So typically in the market, you realize that the culture in Ghana, a lot of people don't look at risk management as an active part of the business, especially when it comes to currency risk management. They tend to look at it on an ad hoc basis. When conditions are deteriorating, that's when people start looking at risk management solutions. So the first thing that a lot of companies need to do is first develop a risk management policy. You need to have a guidance as to what the risks are within your business and how you're going to manage the risks. If you're doing cross-border activity, what percentage of your activity is involved in FX? Which currency pairs are you dealing with? what is the level of volatility within those currency pairs, and how much risk can you tolerate within the business, and how much risk do you need to mitigate? Okay. It's only when companies take time to develop a risk management policy that we can move on to the next stage of how to develop the derivatives market to support that. Okay. So there are a number of things to consider. One is regulatory framework and regulatory stance. I've been having conversations with the regulator for years, and I must say that over the years, the regulator has really improved in terms of their appreciation of risk management solutions and risk management tools. But the regulatory framework is extremely important to allow the derivatives market to develop. Also, the existing macro environment is crucial to developing a derivatives market. Going through the debt exchange did not help because derivatives markets are developed via a stable interest rate market. You need a stable interest rate curve to be able to have a two-way trading of interest rates to be able to then support derivatives market development or risk mitigation, FX hedges. And at the moment, we don't have an efficient interest rate yield curve. So there has to be deliberate effort from both the commercial banks, the market makers, and the regulators in ensuring that the macro stability is maintained such that there is an interest rate curve that can underpin the development of a derivatives market. And then naturally, there's a lot of knowledge gap between the companies themselves on risk mitigation solutions. And there is quite a bit of work that needs to be done to close that gap, to get companies to understand risk mitigation and how to go about mitigating the risk that they have with the solutions within the market and building the confidence around that. So it's quite a bit of a chain in terms of what needs to be done to give the market the confidence. We have executed significant risk mitigation solutions over the years. And our clients have been quite pleased with the solutions we've offered them. But it's been a very small percentage because of the lack of this risk culture within the market and risk management culture within the country, and then also the knowledge gap within the market as well.
Okay, that was quite comprehensive, I must say. Because like I mentioned, it's just a few banks in Ghana which deal in hedging products. And I know about 2 or 3 weeks ago, the central bank organized a series of meetings for market participants where they spoke about the net open position and their desire to introduce options onto the markets. So attendees, let's pay attention to what's happening in the space. The central bank wants to encourage some of these things so it can help businesses, okay, with your flows. Okay, I'll move on to Mark. Mark, there's a lot of tension in the geopolitical space. I mean, we all know what's happening in the world out there. There are shifting trade alliances, and then because of that, there's uncertain capital flows. From where you sit, you are based in Switzerland. You shuffle between the US and the United Kingdom. From where you sit, what should Ghana do to remain attractive to investors and also for us to maintain our currency stability?
I'd like to break this down into a couple of parts. The easy one, as a panelist, nice and easy to give my answer. So let's start with that. Investors have many choices. So when it comes to a country choice, they compete on credibility as much as opportunity. So I canvassed some international investors after leaving the ACI conference, knowing that I was going to be invited back to get some feedback, which I think I'd like to share. So where can Ghana continue to strengthen? 4 areas came back. First, maintain this fantastic macroeconomic discipline through prudent fiscal and monetary policy. Second, deepen the domestic capital markets. Reduce reliance on short-term external financing. Build your capital markets. You heard from Jojo, the rate curve. Third, improve financial market infrastructure. This means across all asset classes. They are all related. The rate curve drives the forward market for FX. The FX market helps drive the rate curve. Commodities help drive inflation. So they're all interconnected. The stock market, securities market. Securities market drives a repo market, which drives short-term interest rates. So they are all connected. there has to be an improvement in financial market structure and regulation. Fourth, continue to improve ease of doing business through regulatory certainty and digital transformation. All of this morning was dedicated to that. It's fantastic. It's going to take some patience, but it's coming. Currency stability is not achieved by intervention alone. Many countries have discovered that. Even Switzerland discovered that when they tried to peg against the euro, locking in a 120 floor, saying we're a buy at 120. It was catastrophic. So, it comes from building confidence. We come back to confidence. The economy can consistently generate exports, attract investment, and maintain sound institutions. Technology plays a major part. You've got technology companies here today. They want to be involved. Encourage that. Electronic trading, transparent price discovery, better treasury management, efficient FX liquidity distribution, all improve confidence, reduce the friction. Ultimately, investors reward predictability. Countries that consistently demonstrate sound governance, modern infrastructure, policy credibility tend to attract more stable long-term capital. Now, I think that's very, very easy for someone on a panel to say, right? You know, you could look that up and get that out, but how do you actually go about and do that? And I think you need to look a little bit deeper into Ghana's marketplace. I'm going to skip forward and just summarize it. So the feedback I got from international investors on Ghana's financial market, it's got a well-developed money market, but it's got a low participation from the international community. Government bonds, well-developed, moderate to high participation. Foreign exchange, well-developed, high participation. Equities, established, moderate participation. Corporate bonds, developing, a low to moderate participation. Derivatives, moderate. Requires perhaps not just an OTC marketplace, perhaps an exchange-traded marketplace. So, given we understand that, what are the main steps that Ghana should do to really attract the international community, maintain macroeconomic stability, increase market liquidity, expand the investor base, maybe go out there, do more roadshows, attract participation from the pension funds, insurance companies, sovereign wealth funds, etc., develop the corporate bond market, credit enhancement mechanisms. We've got some on the panel today. Credit ratings. Develop a deep domestic derivatives market, easily accessible. Perhaps include FX futures, government bond futures, equity index futures, interest rate derivatives. Make them available to the retail side and institutional space. Modernize the market infrastructure. That's ongoing. We've seen the programs today. Central counterparty, potential central counterparty clearing. We've got a private sector one here. Maybe there should be an institution one as well. And improve market accessibility, tax efficient, easy to open accounts, very, very clear international custody. Where is my local currency being held? Where is my securities being held? Strong government-backed legal protection for the investors.
That's a long list, Mark. But
There's a few more. There's a few more.
That's a long list.
I think increasing the products, exchange-traded funds.
Yes.
That's an easy way to get the investors in. Exchange-traded funds, which have at the back of them ability to manage the FX risk. So that's it. Improve the international visibility. The main point that I come to today is this is a 10-year vision. If you compare Ghana with other financial centers, Switzerland built its market on political stability, legal certainty, sophisticated infrastructure, and international openness. South Africa has done something with a deep bond market. Singapore combined macroeconomic credibility with world-class regulation and market infrastructure. Ghana could become the absolute financial center for not just West Africa, but far, far beyond that. They've got that opportunity to do that. And I think that's really, really significant. You've got fantastic advantages, political stability, English as a language of business, respected central bank, established market infrastructure. You've got the springboard to go further and become that hub for West Africa and beyond.
Thank you, Mark. At this point, I'll say it is possible. It is possible. Mark is saying it is possible for Ghana to be the financial hub, if not for West Africa, for all of Africa. Okay.
And beyond.
Wow. And beyond, yes, it is possible. So, Viral, you are in the technology space. You are the Chief Technology Officer for Sika. AI. Now, we cannot do without AI. It's moving rapidly, and there's no more experimentation. Now there's implementation because we are using it. What impact will it have on treasury management, on the entire financial markets, in decision-making over the next 5 years from where you sit?
Thank you. Thank you, Na. That's a very interesting question. As you said, AI now is no longer something, which was experimentation. In the last 3 years, particularly, I think it's exploded. There was a survey recently done where about 80% of the companies surveyed said they were doing, financial companies I'm talking, they were doing something with AI. So it's there, everybody's working with it. I would say there are 3 broad areas where AI is really being used already, and then it will keep on increasing. One is services, and that comes to reconciliation, automation, improving productivity, but also making sure all the reconciliation happens very quickly. The second part is around risk management and compliance. So you have, even like things like cybersecurity, AI is being used, and that's quite significant for financial industry in terms of real-time transaction monitoring, fraud detection. AI is already employed today. Third exciting area, I would say, is the whole prediction and decisioning. So AI allows you to also look at not just the structured data, but a lot of unstructured data that is relevant, that you can use and build into your models to get the insights that can help you to predict cash flows, Mark talked about simulations in the market. So there's a lot more accuracy and quicker analysis that you can have. And people have already started using it and then building around it. Algorithmic trading has been there around. It's not new, but it was largely based on bespoke algorithms and based on largely pricing and financial data in structured format. AI changes that quite a bit because, and as also we know that a lot of times markets also move based on sentiments, other information, data. AI allows you to bring it all together as additional input to build models. So that's started to increase, and that will continue to grow. And I expect that most of the major players would probably be using in 3, 4, 5 years that to drive a lot of the trading, moving the market, making decisions. It's going to be all pervasive, I think. So yeah, I mean that's where I see it's going to have a huge impact. From a treasury and financial perspective, even from retail perspective, I think as if you and me account holders, we'll start getting much more insights. We'll probably get reminders that, hey, you're going to miss payments that you usually pay in some time, or, you're running, or do you want to invest? You're not making good use of your money. You should probably invest in something, tell you in advance, right? So I think it's going to be there all around.
Yeah, so we should all embrace it, no matter the space in which we are. We have just about a minute to go, and within maybe 10 seconds each, Mark, 10 seconds. Each person should just say something briefly. Give an advice to businesses represented here. How should they see cybersecurity for financial stability? Is it just an IT issue, or is something that can disrupt even the economy? Just an advice to institutions represented here.
So, should cybersecurity be treated as a financial stability issue? Absolutely.
Okay. Thank you. Thank you. Thank you.
No, we heard it all today.
The reasons, yes.
It cannot be something that you empower just the low bank to do. It has to come from the top. It has to come from the governments, the infrastructure providers, and it has to be top down.
Everyone should be involved. Thank you. Hey, 10 seconds. You've done well, Mark.
So
Wow.
I wholeheartedly agree with Mark, but one thing I would add is AI is changing and increasing the threat quite significantly. If you have time, go through a YouTube video. You can see at a Black Hat conference, one of the Anthropic research scientists did a speech. His name is Nicholas Carlini, and it just brings to life how quickly AI is detecting vulnerabilities. And, that's just going to make it so easy for a lot of bad actors, and there are lots of them nowadays. It's not just individual fraudsters, organized crime, but also state actors, who's more interested in disruption, not necessarily just, in sort of committing fraud. So technology is good. We are getting more and more connected. That means the threat exposure is bigger. Okay. So this is no longer a side IT issue. Everybody needs to know about it. Everybody needs to understand it. And, we need to, again, use things like AI is like good things to fight the bad actors, right? So, AI can help bad actors, but you can have AI to also help detect and prevent some of this. But yeah, it's absolutely forefront, no longer, IT issue at all.
So every organization should take it seriously. Jojo, you have the final say. 10 seconds.
So just to say that I think any business operating now needs to relook at their entire model, considering the fact that technology is changing the way risk is perceived within the business. So it has to be forefront at the very top and then cascaded down through the entire business.
All right. Thank you so much. Thank you so much. Jojo, Viral, Mark, thank you so much. Please, does maybe just one or two people have anything to ask them directly? Anything pertaining to your organization? Anything you would want to hear them say or answer? Okay, sir. Zenith.
Okay, let me bring the microphone.
Thank you.
What's your name?
My name is Edward. I just wanted to find out this talk of the eco in West Africa and stability. Do you think this thing would ever happen? And especially when we've spent a lot of money on an infrastructure like PAPS to help. What then becomes this whole issue of innovation, technology, and stability? Do you think in a place like West Africa with all that is going on, this eco is just a myth or a reality, and how a technology like PAPS can then influence further innovation and development? Thank you.
Thank you. Jojo, please.
Okay, all right. So the eco in itself is a political decision because the ability to implement a regional currency stems from the political will to do so. But having said that, the focus rather should be on the regional trade cycle and the ease of trade within the region, okay, and ease of payments, wherein someone looking to import or even buy tomatoes from Burkina Faso or from Mali doesn't have to move with cash, physical cash, into the region, can go there in person, get the goods, and make payments seamlessly using their cell phone. That is really what we need to focus on. And just by integrating from a payments platform perspective, it takes away the need for even the eco in itself, unless the political will to connect the entire region via a single currency with a single monetary policy comes to bear, and that can be looked at separately. But from an infrastructure perspective, I believe the technology exists today to be able to drive that efficiency in terms of inter-regional trade without having to get the single currency implemented.
Great.
So I've sat on cross-border country central bank working groups. It's hard. They've had to spend, particularly in emerging markets, the 5 to 10 years to create their own domestic marketplaces, and they're focused on that. How do we then create the cross-border payment systems when different countries have different payment systems that have to be integrated and the technology is outsourced? It's very hard. Political, absolutely. When will it happen? It's going to take time. What's the solution? Personally, private sector, sicker. They stand here perfectly capable, in my opinion, to provide that infrastructure and allow the country time to catch up. A safe and secure payments, properly serviced, properly settled system in a private sector, I think, is going to be the answer for this region before it comes and provided at an international stage. I've sat on these things for 5 to 10 years and it just didn't move. It was like an iceberg, and the private sector was the answer.
A round of applause for them, please.
Thank you so much.
9 panelists, please stand for a group photo.
So the gentleman will be available maybe during lunchtime, or when you have some time, you can speak with them on some of your issues. Thank
Amazing.
you.
While they take the photo, prepare for the next panelists. They'll be speaking on the topic resilient financial innovation, and help me welcome the moderator, Mr. Dustin Kuba, a moderator for this session. A round of applause for him. And he will be joined by Ms. Juliet Akanyameke, the COO of Gibbs, and Mr. Abdul Razak Isaka Ali, the Chief Commercial Operations Officer for Boba Money Fintech Limited, and Mr. Romeo Buje, the CEO of IT Consortium. We are about moving to that session briefly. So they are going to take us through deep conversation on resilient financial innovation. And I hope, yes, wonderful.
Good afternoon, distinguished guests, ladies and gentlemen. I welcome you all to this afternoon's panel discussion on resilient